A large part of inflation, which remains a hot topic for central banks today, was driven during and post COVID pandemic by a sharp rally in commodities like oil, natural gas, and industrial metals. In 2023, things appear to have cooled down. What common threads weave together the fate of energy and industrial metals, and what forces might drive them apart in the future? We talk all about this with Francisco Blanch, Managing Director, Head of Global Commodities and Derivatives Research at Bank of America Securities. Welcome to another episode of the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you are an investor or just want to learn more about the topic, this podcast is for you. I'm Mobeen, Director, Macroeconomics Research and Tactical Solutions at WisdomTree.
And I'm Nitesh, Head of Commodities and Macroeconomic Research here at WisdomTree.
Before we begin, I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and in this episode, Bank of America, and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. So with that, Nitesh, let's kick things off, and I'll pass it over to you for a quick market recap.
Thank you very much, Mobeen. So we're recording this on the 26th of June, which is the weekend after a failed mutiny attempt in Russia. This failed mutiny attempt has reawakened commodity markets back to redrawing attention to some of the risks in Russia. Although the mutiny attempt basically failed, and we don't think anything would necessarily change in terms of the Russian war tactic. We do think that some of the underpricing of risk will be addressed. We're already seeing oil prices bounce up a little this morning after a week of losses, and we're also seeing gold prices rise this morning as well, as people look for more defensive plays. So the broad commodity markets may get a little bit more of a bid as people try to hedge out some of these risks. Elsewhere, over the last few weeks, we've been seeing a bit more stimulus energy coming out from China with a few rate cuts, but nothing really meaningful. No big bazooka has been offered so far. However, the Chinese Securities Journal has reported that some more fiscal stimulus will be offered. And last week we did see China re-engage in providing some stimulus to the electric vehicle markets after the subsidies had come to an end at the end of last year. Elsewhere in the commodity markets, we are seeing some agricultural commodities, seeing a higher bid as a result of weather stress. In the US, crop conditions labeled as moderate to intense drought conditions have actually increased to 64% from just 19% a week ago. So that gives an indication to the extent to which the El Nino weather effects are actually impacting weather conditions and helping the yields of crops actually decline, which may be positive for the agricultural commodity space. But we want to keep that market wrap up fairly short today because we have a guest with us today, Francisco Blanch from Bank of America. Welcome, Francisco.
Thanks for having me, Nitesh and Mobeen. It's great to be here with WisdomTree to discuss commodity markets. Very excited to join you.
Thank you so much. So let's start off talking a little bit about the energy markets. Positioning in oil futures has been super bearish recently. Firstly, do you share that sentiment? And secondly, has anything that's happened over this weekend with Russia really changed the situation?
Hey, Nitesh. I think, look, going back probably the last 6, 9 months, we've seen tremendous pressure to the downside in commodity markets, uh, really coming from the tightening of monetary policy in the US and around the world. Because remember, prior to the Russian invasion of Ukraine, interest rates were zero in Europe and the US. And it's only been in the recent window, recent 15 months or so, that we've seen a very rapid increase in policy rates. So that's, I think, created a tremendous negative headwind for commodities, and we've seen that across the board, whether it's energy, metals, or agricultural commodities. They're all down year on year, with a few exceptions, including perhaps gold and sugar and beef. But it's been a bit of a mini bear market for the commodity complex. And I think the situation in Russia certainly is something that we ought to be very worried about. Um, but so far, it hasn't really amounted to any disruptions. Now, remember, Russia is the world's largest exporter of commodities. It was even larger before all the gas exports to Europe collapsed at the end of in the middle of last year. But really, Russia obviously remains very important to many markets around the world, with its potentially disruptions to grains, or potentially further disruptions to gas. We've seen gas this morning bouncing up in Europe quite aggressively, as concerns have mounted that some of the Russian volumes could be lost additionally. Remember, we still have some gas from Russia flowing through Ukraine, and then we have a lot of LNG exports going into Europe, actually, from Russia still. So I think those are important concerns. But for the time being, it's hard to tell which way this is going to go, and whether it's going to have a meaningful impact on the war, whether it's going to extend it or it's actually going to shorten it. So I think we have to kind of keep a close eye on developments there, and see how things play out. But I don't see a very clear implication, perhaps other than reassessing the view that geopolitics remains a key driver of commodities and a key risk to global markets. And obviously, gold's bounced strongly this morning as well in the back of it, Nitesh.
Thank you so much, Francisco. So, I mean, ignoring what's happened over the past weekend, you know, how binding have the Russian sanctions been? Are they effective in what they do? And you know, um, you know, are the sanctions being experienced very differently for crude and product markets? Tell us a little bit about your thoughts there.
So, look, one of the interesting parts of this Russia sanctions is that they've been very effective at pursuing the dual objective set out by the U.S. Treasury at the very beginning of the process. I remember these sanctions were supposed to bring inflation down by preventing a major loss of Russian energy export volumes, and therefore avoiding a repeat of what we saw in European natural gas markets. But at the same time, pressuring revenues for the Russian government, so they would have less money available in the war effort. And I think we've seen both. We've seen inflation coming down, and we've seen the Russian financial position getting more and more strained. I think this events over the weekend partially reflect that strain between the paramilitaries in Wagner and the official Russian military forces. And I just think that they have less money, and of course less resources. And we are seeing it across many different channels, because it's not just being financial sanctions, but also sanctions on a lot of equipment that exports into Russia. So all of that, I think, is clearly putting a lot of strain on their military operations. So sanctions have been very effective, and they've been effective on two fronts. They've curtailed, like I said, they've curtailed revenue. They've kept volumes flowing, and those volumes, interestingly enough, have also been sustained at a petroleum product level, which has enabled the price of diesel, which hit a record level of $215 a barrel last year, to come down as well. Remember, Russia is one of the world's largest exporters of petroleum products, right after the U.S. So enabling the exports of diesel, was also very important in order to prevent price spikes, and the measures were successful there too. We've seen a price cap of $100 a barrel on diesel and a price cap of $60 a barrel on crude oil. And again, that's enabled a lot of Russian volumes to hit the market and kept the European economy well supplied, even though Europe is no longer importing Russian diesel. It's importing diesel from other parts of the world, like Turkey or the Middle East. So Russian diesel is making its way to other markets. So that's been very effective, I would say, at doing both, pursuing both objectives, Nitesh.
That's great. And so, with OPEC cutting back on production, the sanctions on Russia, holding some barrels back, um, and oil curves, both Brent and WTI, largely in backwardation. You would expect this to be an environment where you would see oil rigs in the US expand. Historically, with slightly higher prices for oil, we've seen much more expansion in oil rigs in the US. Why are we seeing this time round? Why are oil rigs largely stalled in the US?
Well, I mean, I think there's a number of issues with U.S. shale. First and foremost, we've seen a big shift in spending patterns, in investment patterns. Companies are trying to be as ruthlessly financially efficient as possible, and shareholders have been asking these companies to return money back to shareholders after really not doing very well financially for many years. So now shareholders are finally getting their money back, and they're very happy about it. So companies have a lot of pressure to maintain that pace of dividends, of share buybacks. So that's one element of it. The other big element that's often not widely discussed is that the shale resource is getting tighter too. If you look at the different basins across America, if you look at the Bakken, the Eagle Ford, Niobrara, they're essentially flat. They've been flat for a while. The only place that we've seen growth has been in the Permian Basin. And even the Permian Basin is maybe 12, 18, 24 months away from hitting a peak. So U.S. shale production is going to end up peaking a little above the current levels over the course of the next 12 to 24 months. And I think companies realize that the resource is not as ample as perhaps thought. And maybe 15 years ago, we had 25 years of reserve life. Now we have, of course, after 15 years, just 10 years of reserve life. So many companies have 5, 6, 7, 8 years of reserve life. They have no incentive to accelerate their drilling because their company value would drop if they essentially became 2, 3 year entities, right? So there's a lot of activity for corporate control, a lot of mergers, acquisitions, divestments. But in terms of incremental production, we're just not there. The resource is not there at the price that would make sense, like $60 a barrel. I mean, if you keep going higher, of course, there's going to be other sources of potential oil additions that could come into play, but not at these levels. And that's why you're seeing what you're seeing. You're seeing more financial restraint and more focus on improving financial operations at all these shale drillers, but also looking at the resource itself and realizing that maybe you just want to consolidate and extend the life of the entity as opposed to accelerate growth.
Francisco, the International Energy Agency recently published its June oil market report, and they took a fairly constructive view on China's rebound and demand for oil, particularly. Now, many people have expressed disappointment over China's recovery. Some urge patience to let the recovery story unfold. How do you see China's recovery and its impact on energy prices?
Look, Mobeen, China has been recovering quite nicely from a service standpoint. We've seen the services economy picking up. Mobility across the country has certainly seen a big uplift, and even international mobility in and out of China has seen a strong pickup. But the weakness in China is really arising from two main sectors. One is industry, and one is the real estate sector. Now, when it comes to industry, remember China is the factory of the world, so weakness in demand for goods relative to demand for services around the planet has been impacting China negatively. Of course, there's also the reshoring, friendshoring, nearshoring story playing out. So that I think has been a drag on oil demand from the industrial sector in China. And then the second sector where we've seen a lot of weakness is real estate, where there's an element of demographics. Obviously, China's population's peaking and likely heading a little lower from here. Plus, of course, the Communist Party has been very focused in China on trying to slow down speculation in real estate. So they are not, I think, ready to reignite it aggressively again, right? So I think it's this combination of weak growth on those two sectors that has been perhaps holding back a little bit of Chinese demand. We've seen it more materially in industrial metals than we have in oil. But I think the weakness in energy will start to ease off as those two sectors improve with potential stimulus measures that are being considered and could be put on the pipeline.
And Francisco, just thinking long term about oil prices, some argue that because we're transitioning away from fossil fuel and there's this energy transition happening, there's a lack of investment maybe in the oil sector, and the dynamics between how quickly demand falls versus the dynamic between how quickly supply might fall in the long term. How might that impact oil prices in the long term as you think about over the next decade or so? Do you take a long-term view on oil prices as well?
We don't have a very long-term view besides kind of the next 4 or 5 years. That's kind of our medium-term outlook for oil, and we think oil is a 60 to $80 commodity in that range. That's roughly where forward prices are. Forward prices have been hovering around 65, 70, 75 a barrel for a pretty long time, and we take the view that they will anchor at those levels. Now, having said all that, the uncertainty on oil supply is pretty dramatic. We've seen a drop in investment. We recently had our commodity conference where we had some speakers talk about the drop in investment and how that is likely to impact the ability of the market to source oil. So I think a very important question, as you said, is when does oil demand peak? Because we're clearly not going to have supply to meet incremental demand for oil. And there we take the view that oil demand will likely peak at around 2027, 2020. So we are not that far away, 4 or 5 years well, from peak oil demand. And then we'll start a relatively slow decline. But remember, even under most scenarios, we still need a lot of oil by 2050. Now, some people ask me often, okay, so Francisco, as you think about the next 20, 30 years, and we go into a net zero, we don't need any oil. Well, that's not exactly true. In fact, if you look at net zero, even the net zero scenario that the International Energy Agency has put out has a 20% allocation to hydrocarbons, oil and gas hydrocarbons, from around 60%. But if you look at the other scenarios, the aggressive scenario or the more mild business as usual scenario, these are scenarios where we could see still 60% of the world's energy demand coming from oil and gas. So yes, if we get to net zero by 2050, we may not need that much oil, but under most other scenarios, oil demand is likely to be 90 to 100 million barrels a day, which is a little below where we are today, but not much.
That's great. I mean, talking about energy transition, what role do carbon markets play in energy transition?
So carbon markets play a very, very important role, right? I mean, I think carbon is probably going to end up being one of the most, if not the most important commodity in the planet. And the reason I say that is because if we are committed and serious about the energy transition, and I think we really are at this point, right? I think the need to tax pollution, right, is an imperative to achieve our decarbonization targets and therefore limit the rise in global temperatures beyond the level where it will make the planet very hard to inhabit. So I think we are at this stage looking at carbon as a tool that will help us prevent the rising global temperatures and essentially put a price on something that hasn't had a price for 150 years, which is the emission of greenhouse gases in the atmosphere. Um, so now there's a price for that, and I think it's a price that's going to keep rising over time, because whether we get to net zero or we end up with an aggressive decarbonization scenario or something milder, we're still going to have we're going to have to put a price on carbon. We're going to have to make polluters, and I think this is just fair, right? I mean, if you pollute something, you have to pay for it, right? And in the case of Earth, well, it's even more important. So I think over time, the price of carbon will keep rising, be a critical tool, and I think we'll see more countries developing carbon schemes over time, not less. So it's not only an important commodity in terms of preventing climate change or slowing it down, but also it's an important commodity that it's going to affect portfolios in every possible regard. It's going to impact not just commodity portfolios, but also equity portfolios and fixed income portfolios, because companies will have to factor this into their balance sheet, will have to factor this into their profit and loss accounts. So this is the one commodity that you can really not miss out on. Whether you're an airline, you're a chemical, you're an energy oil company, you're a refiner, um, you're in the metal smelting business, you're an industrial manufacturer. Very few companies have little carbon footprint. Even large tech companies have a large carbon footprint by virtue of increasing their data processing facilities, which are, by the way, huge users of energy. And I think carbon over time will play a very important role that will impact all financial sectors of the economy, much more so than any other commodity that we deal in today.
Speaking of decarbonization, Francisco, one sector that's, of course, very relevant to that discussion is industrial metals. And in 2022, particularly in the first half, when we used to talk to investors about the energy transition and its impact on industrial metals, many people asked if that story was already priced in, because at that time, metals were seeing a bull market. But now we're seeing weakness, and maybe that's a case of industrial metals being more cyclical rather than more structural in terms of what they're pricing in today. How do you see that? Do you think industrial metals are still being responsive to what central banks are doing, expectations of recession, and so forth? And is there a point when that energy transition story will start being priced in a lot more into the industrial metal sector, or are cyclical headwinds continue? Will they continue to dominate the story and the fortunes?
Well, I think in the short run, we are likely to see some downside pressure across the commodity complex until interest rates stop going up. Right? I mean, the increasing cost of money is however, a dual-edged sword. On the one hand, it's trying to slow down demand, but also remember it can slow down supply by reducing investment, because simply you increase the hurdle on putting more money into your next factory, into your next mine, into your next smelter. So I think once the monetary tightening cycle ends, a lot of the commodities are going to experience a big resurgence in price, and I think metals will be definitely at the very leading edge of this. Now, of course, with a slower China, maybe China's going to need less metal, right? And that's probably going to provide some relief. But in our estimates, there's so many uses of metal in the energy transition, from investing in the grid that we need to essentially decarbonize the planet. Remember, decarbonization is going from oil and coal to natural gas to renewables, and renewables are mostly metals, right? And we need to invest a huge amount of money to get all the copper tons that we need. We need aluminum to do things like, for example, lightweighting vehicles. We also need silver for solar panels. We need platinum for the hydrogen economy. We need lithium for batteries and cobalt and nickel. So there's a very, very large array of metals that are heavily used in decarbonization technologies, which over time I think will create a big run up in prices. Now, this is obviously not going to happen until interest rates stop hiking, because until interest rates stop hiking, the metals and the commodities more broadly will face those headwinds from demand. But I do think ultimately and I think a lot of investors will agree with me that if you look at the next 10 and 20 years, the metal space offers probably among the most interesting opportunities in the commodity complex, given the fact that it takes a very long time, 7 to 10 years, to develop a mine, and that we've been under investing now for more than a decade in the metal sector. So it's probably, like I said, one of the more interesting spaces, and all the investment that we need to do to decarbonize will have to translate into much greater demand, which obviously in the case of metals will most likely translate into higher prices.
So, Francisco, we've got one more question for you, and I do apologize. It's probably one of the most difficult ones, but where do you see the big tail risks in the commodity markets? I mean, nobody has perfect visibility. We will try to analyze the market, but there are always tail risks, positive and negative. Where do you see them?
Sure, Nitesh. I mean, I think on the downside, the most clear downside risk probably is around the economy, taking commodities lower, and that could easily happen if interest rates end up at a point where we end up creating a major economic downturn. Now, it's difficult to say whether we will or not, and certainly the markets are not pricing that in at the moment. But of course, we've gone from, as I said before, zero interest rates 15 months ago to a level of policy rates that it's already quite biting. And the Fed still has to hike maybe 2 more times over the next few months. Same for the European Central Bank. We are seeing similar pressures in the UK, with rates going above and beyond what anyone expected. So that could lead to, I think, a very negative economic outcome, which would take commodities lower. So that's one major tail risk for the commodity complex. Now, to the upside, I think 2 things are worth mentioning. One is China stimulus. We are seeing the Chinese government realizing they have to put more stimulus at work. Now, they're of course nervous about ending up with double-digit inflation like we ended up here in Europe, US, UK. But at the same time, they have youth unemployment around 20%, so they got to do something to get people back to work. So it's kind of that balance, and I think if they overdo the stimulus program, we could end up with a very meaningful bounce in commodity prices, as we've always done every time China stimulated a little too aggressively. Now, the second upside risk I can see for the commodity complex could come from geopolitics. This weekend gave us a taste of what could be like to have turmoil in the world's largest commodity exporter, which also, unfortunately, happens to be the world's largest holder of nuclear warheads. So a bit of a concerning situation, and that's one of the reasons I think why gold's going up, right? Because geopolitics are red hot. And that, in my mind, can also create upside risks. I mean, we talked about the grain deal that needs to be renewed. There is also, like I said, a fair amount of commodities still leaving Russia that could be curtailed. So, Nitesh, I think geopolitics, I would probably put it as number 2, as one of the key risks to the upside in the commodity complex here. And those would be my main upside and downside risks as we think about the complex over the course of the next 6 months.
Wow, Francisco, thank you so much for sharing your insights with our audience. We really appreciate you coming and joining us here. So that's at the end of our commodity exchange podcast. I don't know, Mobeen, if you have any outgoing comments.
Before we close, Francisco, for our audience, if they want to hear more from you, where can they find you?
Well, they can find me on. I do regular Bloomberg TV. I do CNBC, so you can look me up there. And then, of course, if you're a client of the Bank of America, you can get access to our research directly. And then, of course, I try to do some media, written media as well occasionally. So that's where to find. That's where, and of course, you can also find me at Wisdom Tree again whenever you need me. So.
Excellent. Thank you very much. And thank you, everyone, for tuning in. We hope you enjoy this episode of the Commodity Exchange. And if you want to hear more from us, please subscribe on whichever platform you're using. And don't forget to leave us a rating. You can follow Nitesh and myself on Twitter at Nitesh Shah WT and at Mobeen Tahir WT. And if you want to learn more about commodities, visit Wisdom Tree's website, where we have a wide range of research materials and insights. Until next time.